Let's bring in Gene Munster, managing partner at venture capital firm Loup Ventures. Gene, great to get your take. I don't know where you want to start. A lot to talk about. Amazon, you didn't think it was as bad as the stock reaction is. Why?
Yeah, Melissa, normally this would be down 5 or 10%. Down 15 seems like an overreaction. The paid unit growth continued to be strong. I was impressed by that. It was up 11% year over year. And I just begged the question to the panel, the group, what ultimately, this is being painted as some horrible guidance. What was so horrible about the guidance?
Well, I mean, how about their best quarter? You're talking about 2 to 8% growth, and arguably we still should be coming out. Everyone's telling us that the consumer's never been healthier, and at least right now that hasn't been the story. So the other dynamic is on AWS, though. I mean, isn't that really where the market is punishing the stock?
It is. It grew at 27% versus 33, 35% in previous quarters. It's a deceleration, but I just want to put that in a context that, we're seeing decelerations across the board. This is bad, and I think the biggest takeaway from Amazon is the generals are being shot. And this is a mistake that I've made. We own Amazon. A mistake that I've made is thinking that there was some safety in some of these large cap tech companies. And ultimately, what we're seeing is, my general view is that the guidance wasn't that bad, but that doesn't matter. What matters is that it was a subtraction key. They hit the subtraction key, and that's not what investors want to see. And I'll just point out one further piece. I'm still a believer in Amazon. I think what they're building around logistics is something that no one else can compete with. But I do want to point out that even with these lower numbers, this is still going to be, even with the stock down 15%, still a relatively expensive stock. And so you really have to have a view of kind of what's 1, 2, 3 years out when you're thinking about investing in Amazon. I think that this was, the guidance wasn't that bad, but I think what was really bad is just the read on how investors are thinking about large cap tech more broadly.
So, Gene, does that make you worried about Apple and the guidance that we haven't had yet? And if that guidance is kind of lukewarm and it's not conservative, and Karen just said that, you thought the Amazon guidance was conservative. If Apple's guidance is not conservative, does it give you more confidence that maybe they're doing better than some of their large cap peers? Or does it actually leave the question mark open for the next quarter?
I actually think they're doing better. And let me put some context in terms of Apple's results. The big focus point, of course, is the iPhone. It was up 10% year over year. The street was looking for 12% growth. That, by definition, is a miss. It was up against a 47% comp, massive comp. Other big companies weren't producing off that comp. And separately, Cook, through CNBC's reporting, is talking about them still being supply constrained. That was not a surprise to me. As of today, we're still seeing 3 to 4 weeks lead times in 8 countries around their Pro models. Typically, 6 weeks into the cycle, where we're at right now, you would see lead times around 1 week. And so when I put this together, and you just have to peel back below the layers, when I put Apple's results together, it's quite remarkable that they're able to grow at 10% off a 47% comp with the iPhone, and it probably would have been a better number. The Mac, they beat expectations by 25%. It's 10% of the business. The iPad was soft. It was down, I think, 17%. But that's going to see a big rebound in December with the updates that they just did to iPad. And so when I think you put all this together, what's the simple takeaway with Apple? Is we're dependent on their products. And ultimately is whether things are difficult. Yes, there's going to be some softness in services, and there's going to be some edge around what's going to happen with iPad. But as we become more and more dependent on their products, they're going to keep powering through. And I think this stock is going to surprise people over the next couple of years. One last piece is we're talking about what's going on today. If we start thinking forward 2 years, 3 years down the road, what other things that Apple's working on, whether it's going to be something in dare I say, the metaverse, mixed reality, augmented reality, or something in automotive, that's just another game changer to the multiple. So I actually left feeling that this company is as strong as ever.
All right, Gene, thank you. We'll check back with you a little bit later on this hour. The stock is virtually flat in the after-hours session at this point, Guy.
We're dependent on food, oxygen, and to a certain point, love and water. Guy. That's what we're dependent on. We think we're dependent upon Apple, and that's the genius of what they've done. They've convinced everybody who thinks we can't live without them. Number one, I'm not looking at Gene, but that's just my quick takeaway. Amazon, real quick, and this is them talking. They're looking at their cost structure and where in areas where we can save money. What does that mean? It means people are going to get laid off, which probably plays right into the narrative the Fed is hoping for. But again, that's the environment that we find ourselves. So spread it out. If this economy is as great as everybody, wants to say, it's not that great, and things seemingly are getting worse. And Amazon is telling you exactly that.
All right.